What if your grocery bill kept skyrocketing, your job felt less secure, and your savings bought less every month, all at the same time? This isn't a hypothetical. It's called stagflation, the economic monster that haunted the 1970s, and a growing number of indicators suggest it's stirring from its slumber. Imagine paying 1970s prices while earning 1930s wages. Welcome to the central banker's worst nightmare. Stagflation is the toxic combination of three elements: high inflation, stagnant economic growth, and rising unemployment. It's a direct violation of the Phillips curve, the old economic rule that said inflation and unemployment had an inverse relationship. In a normal recession, prices fall as demand collapses. In normal inflation, the economy overheats and jobs are plentiful. Stagflation gives you the worst of both worlds. The price spikes of an overheated economy with the job losses and stagnation of a recession. It's an economic trap where traditional policy tools become useless or even harmful. To understand the risk, we must look back to the 1970s. The decade began with loose monetary policy and massive government spending on the Vietnam War and social programs. Then came the shock, the 1973 OPEC oil embargo. Oil prices quadrupled. This wasn't a demand problem. It was a supply shock that rippled through every industry. Compounding this was a wage price spiral. Unions demanded higher wages to keep up with prices, and companies raised prices to pay those wages, creating a vicious cycle. The result? Inflation hit 14% by 1980, while unemployment soared to nearly 8%. Growth flatlined for a decade. Today, the parallels are unnerving. The 2020s began with unprecedented monetary and fiscal stimulus. Then came the supply shocks, a global pandemic that fractured supply chains, followed by Russia's invasion of Ukraine that sent energy and food prices into orbit. Geopolitical tensions are threatening other critical trade routes. These are classic cost-push inflationary forces, not driven by consumer euphoria, but by broken production systems. Just like the 1970s, we're facing persistent inflation born from the supply side, not the demand side. This creates an impossible dilemma for central banks like the Federal Reserve. Their only real tool to fight inflation is raising interest rates, which works by crushing demand. It makes borrowing expensive, cools business investment, and aims to loosen the job market. But if today's inflation is caused by supply shortages and geopolitical strife, crushing demand doesn't fix the broken supply chain or end a war. It simply adds a recession on top of the inflation. The Fed is trying to thread a needle in the dark, raise rates enough to tame prices, but not so much that they trigger mass unemployment. In stagflation, this soft landing becomes a near impossible fantasy. The most dangerous feedback loop in stagflation is the wage price spiral. When workers see prices rising 5% or 6% a year, they demand raises to keep up. If they get them, businesses face higher labor costs and raise prices further to protect profits, which leads workers to demand even higher wages. This cycle becomes embedded in the economy's psychology. We're seeing early signs. After decades of stagnation, wages have grown significantly, but there's still lagging inflation in many sectors. The risk is that expectations of permanent high inflation become a self-fulfilling prophecy, locking in higher prices for years. Another key ingredient of 1970 stagflation was a productivity slowdown. Despite the space race and computerization, broad-based economic efficiency gains stalled. We may be in a similar paradox today. We have artificial intelligence, automation, and the internet, yet measured productivity growth has been disappointing for 2 decades. The benefits of technology seem concentrated in a few sectors and among capital owners, not flowing to widespread wage growth or cheaper goods. Without strong productivity growth to offset rising costs, the economy naturally tilts towards stagnation with inflation. The 1970s stagflation eventually ended due to two things: Paul Volcker's brutally high interest rates that caused a severe recession, and the globalization wave of the 1980s and 1990s that brought a flood of cheap goods and labor from China and the emerging world. Today, that second cure is reversing. Deglobalization, friendshoring, trade wars, and supply chain resilience means production is moving to more expensive regions. This adds a permanent geopolitical security premium to the cost of goods, making the disinflationary tailwind of the past 30 years a headwind for the next 30. So, what can you do if stagflation arrives? Historically, certain assets perform better than others. Tangible assets like commodities, gold, oil, agricultural products, and real estate often hold value as money devalues. Stocks of companies with strong pricing power and essential goods can weather the storm. Treasury bonds, typically a safe haven, can get crushed by persistent inflation. On a personal level, reducing debt, especially variable rate debt, upskilling to stay employed, and building an emergency fund become critical survival tactics. It's about defense, not aggressive growth. Are we doomed to repeat the 1970s? Not necessarily. Central banks are aware of the risks and are theoretically more independent. Labor unions are far weaker today, potentially muting the wage price spiral. But the warning signs are converging: stubborn core inflation, slowing GDP growth, an increasingly fragile job market, and persistent supply-side constraints. Stagflation represents the worst of all economic worlds, and while we're not there yet, the probability is higher than it's been in 50 years. Ignoring the risk is a luxury we can't afford. The 2020s economy is walking a tightrope, and the net below is looking very thin.